Hello everyone, I'm Anthony Boakes and I'm with you today with my colleagues Giles Lang and Julia Clark to talk to you about the budget yesterday, and I think we can all agree it was a fairly consequential event, can't we?
Yeah.
Quite a lot of changes which we'll go through. So over to Julia, who's going to start with the first section.
Well, starting with changes for employers, I mean, following the election promises, NIC was not something that I really thought was on the table. However, in the weeks running up to the budget, it suddenly became clear that the Labour manifesto, when it had promised not to raise NIC, was actually talking about NIC for employees. And all of a sudden, NIC for employers was very much on the table. And it was clear that they were definitely going to make an increase. Now, employers pay secondary Class 1 NICs currently at 13.8% on salaries above 9,100. So not only now, though, have we got an increase in the rate from the 13.8% to 15%, but also on the threshold above which you pay it. Or rather, I should say that's a reduction, because now it's going to be paid from £5,000 instead of 9,100. And in addition to that, if employers were not feeling sufficiently hard done by, there's changes to the national living wage and the minimum wage as well. So really, with the increases there and the increased NIC, it's going to massively up the cost of employing people. So, Anthony, I think it was your idea that we're perhaps looking at a small pub.
Absolutely. I think that pubs at the moment, obviously, there are some small pubs are struggling already. Cost of materials, labour costs, etc. Things are not great out there. And these changes are going to be a significant kick in the teeth to some of those pubs.
So I won't say I'm an expert on the type of staff that pubs employ, but I've had a go here with considering I've got one pub manager and maybe a chef, 4 full-time people on roughly minimum wage, and then a few students popping in for 16 hours a week to help the grants out. So these salary amounts that I've quoted are, effectively what they were being paid, if you like, before the budget or before the budgetary changes. And you can see there I've done the salary cost, which includes the NI, before the budget. And then with these changes that are going to come in from April 2025, there's the comparative. And there's a whopping increase there of 18,248. And of course, our concern isn't it? This is going to impact, the profitability of the business or their ability to attract staff if they can't pay such high levels going forward.
So if you've got a small pub or a small restaurant or an independent business of any kind, or even if you're a bigger employer, I mean, this is going to be a huge thing, isn't it? Yes. If you're bringing an independent restaurant that's already struggling, and that this is a significant increase in your costs.
The hospitality trade in itself is going to be, they were struggling before.
Yeah, absolutely.
Yeah. It's going to be even more significant now.
Yeah, so I think these changes will have a big impact for bigger employers as well. I mean, we as a firm, we've been looking at the cost to us. It is quite significant, and there'll be a lot of employers out there thinking, well, oh my word, I mean, these changes are quite big. So to reduce both the threshold where the NI starts to kick in at 5,000 and also increase the rate to 15%, it's going to have a big impact on the bills for employers, both big and small.
Interestingly, though, of the 40 billion tax increase, this accounts for about 23 billion of it. So,
yeah, I mean, this is the big.
You can see why she's done it.
This is the big ticket item that they've done. This is going to be the real revenue raiser for the revenue. A lot of the other stuff they've done it is big and will be big to some people, but this is the real big thing that's going to raise the revenue that they need.
Absolutely.
Of course, one small chink of light, I suppose, is the increase in the employment allowance. Previously, small employers could knock 5,000 off their national insurance bill, and that has been increased to 10.5. So that will increase the impact of this measure slightly. But still, overall, especially for slightly bigger employers, it is a concerning increase, and I think it will increase pressure on a lot of small businesses.
Well, I've rushed on ahead here, I'm afraid, but corporate tax roadmap. Now, initially, You could say that there's not that much on corporate tax in the budget, but they did tell us they were going to do the roadmap. And in essence, some of the key issues here are no change for the moment. It's very much a case of we recognise that you as businesses need stability, and so we're capping the main rate of CT at 25% for the duration of this Parliament. But they have said they'll keep an eye on sort of international developments as well, because they do want to make sure that the UK's regime remains competitive. We're also keeping our small profits rate of 19% and the marginal relief. None of that is changing. On the capital allowances side, the so-called full expensing, which is the 100% first year allowance for certain plant and machinery, and also the £1 million annual investment allowance, they are also staying. And they have said, as the Tories did, that they will explore an extension of the full expensing to include assets that are actually purchased to lease out or hire out.
So very few changes really on the corporate tax side.
Very few. They have said they're going to look at certain things administratively, and there does seem to be a focus on sort of international tax and what they could do to clarify things or help people be compliant. So.
And what they've tried to do is they've tried to give certainty to business as to what it looks like for the term of the Parliament, which is the point of the roadmap.
Indeed, indeed. I mean, capital allowances for so long have been the thing that they've tweaked up, down, round about every budget for years, hasn't it?
Yes.
And now for the big changes.
Yeah,
Although
no, I mean, I'll let you speak, Giles, but these changes I think these are very consequential for many of our clients.
Yeah, so I'm going to consider the inheritance tax changes following the budget. Firstly, the inheritance tax nil rate band allowance of 325,000, which was set to be frozen until 2028, will now be extended until 2030. So this means that assets in your estate that appreciate in value with inflation will become more exposed to potential inheritance tax. This budget has also brought a significant change to pensions. Pensions were a useful tax planning tool to avoid inheritance tax completely. As of April 2027, this will no longer be the case. Your pension fund will form part of your estate and potentially liable to inheritance tax.
So just a bit in there slightly. So just to explain what the current law is. The current law is that many of you will have pension funds that are obviously quite valuable, and generally you will have those written in trust to go to the next generation. And at the moment, as the law stands, those pension funds will typically go free of inheritance tax. But in what is a very significant change, and we've got more significant changes to talk about, but what is a very significant change, that's all going to change.
Yeah, absolutely. And probably the biggest change that we can see is the reform of agricultural property relief and business property relief, otherwise known as APR and BPR. These reliefs have previously provided an exemption from IHT, but from April 2026, this will no longer be the case. The rules state that the first £1 million value of a business asset or agricultural asset will receive that full relief that it had before. Any amounts over this will receive 50% relief. So the remaining 50% will be taxable to inheritance tax at 40%. So given an effective tax rate of 20% over £1 million.
So that is a massive change. If you've got some of our clients will have very valuable businesses. Many of them will be worth more than £1 million, and where they would have expected to pay no inheritance tax at all, now there will be inheritance tax if they don't take any action before 2026.
Yeah, we can break it down into an example. So if we take a business valued at £10 million, the first million, well, today that 10 million would be safe from inheritance tax. But from the new rules, the first million will receive full relief, so no inheritance tax at that stage. The remaining 9 million will receive 50% relief, so there'll be a taxable amount on the remaining 4.5 million, which is going to generate a tax liability of £1.8 million.
So I mean that is a massive change. So going from what what would have been zero tax. So obviously in the East Midlands, we've got a lot of agricultural businesses, and we've got a lot of trading businesses as well. And it's often been quite good tax planning for grandma and granddad to keep the business.
Just to hold on to that business until death.
Hold on to that business in the knowledge that it would be, you could pass it down to the next generation free of tax. Some people have invested heavily in farmland. I can think of one particular gentleman who also does vacuum cleaners, who's invested very heavily in Lincolnshire farmland. And well, his planning is not looking quite as good as it was.
No, so the importance of succession planning moving forward will be massive. It's going to be hugely important.
So the other one that we were very well aware that changes were coming for was capital gains tax. So what we have are some rate changes for disposals on or after budget day itself, 30th of October 2024. And so from the 10% and 20% rates that we had, we've now got new higher rates of 18% and 24%. These are the rates that we've actually had for residential property for a while. We were worried perhaps that they were going to tackle business asset disposal relief and alongside that investors relief, but these have actually been retained. However, currently, of course, with the business asset disposal relief, you get a 10% tax rate. That's going up to 14% for disposals on or after April 25, and then 18% for disposals on or after April 26, or 6th of April 26, I should say. And then with investors relief, they still had a lifetime limit of 10 million, although the business asset disposal relief had come down to 1 million. Now investors relief is coming down to 1 million lifetime limit as well.
So again, some quite significant changes there.
Yeah.
Just in case people weren't aware, the business asset disposal relief was formerly known as entrepreneurs relief. So
I think most people still call it that.
a lot of people still call it entrepreneurs relief. So just to make sure everyone knows what we're talking about.
Yeah.
But the rates have obviously increased. Maybe not quite as bad as we thought it might be.
Well, no, but we were all sort of rushing to get certain deals that we knew were going to happen over the line beforehand, but they've kind of I don't know, boulder googly, is that the expression, by bringing in this anti-forestalling rules, because the basic rule for capital gains tax has always been that the point of the gain or loss or whatever is actually exchange of contract, not completion. But what they've actually said here is that if you've exchanged contracts before the budget but you're not completing until after, and we have a client who actually isn't planning because they're a farmer to complete for nearly a year because they want to carry on and get their harvest in before they actually pass the assets over. But then you're going to have to demonstrate that the purpose of exchanging before budget was not to obtain a tax advantage under these rules. And if the parties are connected as well, you're going to have to prove that the contract was actually entered into for commercial reasons. So it's tricky. And then obviously where you qualify for the business asset disposal relief or the investor relief and your contract's made somewhere between 30th of October 24 and the 5th of April 2026, and then and completed from 6th of April 2025, then that is presumably going to fall under those same anti-forestalling rules, and you're going to have to make declarations about the purpose.
Yeah, so as they often do, they've changed the rules with immediate effect, which is why we're all running about, all of us in the corporate tax world, and also all the corporate lawyers up and down the country, that we're all running around trying to get deals done before the budget, for good reason, because they do change things with instant effect, and then they put anti-forestalling rules in to make sure that you can't sort of fudge around the rule changes. Absolutely. So all those late nights that corporate lawyers have been doing have all been worthwhile, I think.
If they've managed to complete as well as exchanging.
Yeah.
Yes.
So one thing that was in the budget that I do want to talk about that hasn't been affected actually, and is a beneficial item in the budget is employee ownership trusts. So these are becoming ever more popular. They were originally enacted in 2014. They've been going about 10 years, and it was originally came from a report that said that employee-owned companies are more productive, profitable, and more beneficial to employees. So they want to encourage employee ownership. But initially there was quite a slow take-up. But over the past year or so, I've seen a big tick-up in interest in these structures. And the revenue have been looking at them. There's been a consultation into whether the rules are working as they intended for the past couple of years. And the consultation has now been concluded in this budget. And thankfully, they've kept EOTs in place. But there's been some tightening of the rules, but those changes have been largely very welcome, actually, just to clarify the tax treatment of a certain few things. And these structures remain very appealing to vendors, sellers, and the main reason for that is that you can sell to an EOT with no tax at all. So that, compared to capital gains tax rates, obviously capital gains is going up. So this will become an ever more popular exit route, I would have thought. So how do they work? So the sale is typically funded through the existing cash resources of the company and then instalments out of future profits. And following the sale, the company is owned by a trust that's been set up to benefit employees. One important law change, which is something that we were doing already, actually, to be fair, is that the vendors will normally stay on to see the company through, to lend their experience to the new management team, and also to protect their investment while they're still owed money. But they mustn't control the board of trustees, because it's the board of trustees that control the shareholding power, and the vendors, there should be seen to be a genuine change of control. So the vendors will often stay on, but there will need to be a minority of the board of trustees. And that was one of the changes that's been recommended by the consultation document. So just to look at an example of what an EOT might look like. So if you've got a company where a founder set it up with £100 originally, and he's turned that into a £10 million company, he's done very well for himself or herself. So with a trade sale or a management buyout, a typical sort of exit route, the capital gains tax might be about 2.34 million under the new rules that come into place shortly. So out of his 10 million, the vendor has retained 7.66 million. Whereas if he was then instead to say, well, actually, I'll sell to an EOT instead, his tax bill will be zero, which is quite a big, that's quite a big relief.
Yeah, it's a good difference, that.
It's a good difference. So then the cash retained by him will be the full 10 million. So he saved an awful lot of money. He's kind of secured his legacy. He's passed the company down to the employees. You need a strong management team in place to make it work. But yeah, if you get the strong management team along with the vendors during the first 3 or 4 years of the EOT period, it can be really successful. And I think in the long term, we'll start to see more and more of these companies.
So that's a benefit to the vendor. Is there a benefit to the employees that are staying on?
So the employees, during that, they can have tax-free bonuses, relatively minor, 3,600 tax-free bonuses. But in the long term, once the vendors have been paid off, you can see a situation where actually then let's say you've got a company that's got 25 employees and the company's made £1 million of profit, then that profit will be available to split amongst employees, available to get to entice new, exciting talent to the company. Salaries, bonuses, so in the long term, there'll be a real opportunity for those employees to benefit from from what's been built up. So in the short term, the employees probably, their bonuses are fairly limited, but in the medium, long term, they'll do very well.
So I thought I'd say a little something about stamp duty, land tax. it's not of universal interest, perhaps, but we're talking here about the surcharge above standard residential rates, and this applies to sort of second homes, but obviously is also going to impact landlords as well, because typically they would buy multiple properties, and that wonderful expression "non-natural persons," which always has me smiling. Basically, it's going to apply to transactions with an effective date on or after 31st of October 2024. But again, where the exchange predates 31st of October, but then completion is later, they've said there's probably going to be transitional rules. So they haven't spelled it out. But effectively, again, instead of looking really at exchange, they seem to be tending to look more towards completion. And then there's this higher sort of fixed higher rate rather than the surcharge for companies and non-natural persons where they buy a single dwelling that's more than £500,000. There's this special rate of 15%. Essentially, it's where properties have fallen for this annual tax on envelope dwellings. In other words, really, they're looking at sort of owners who want to sort of buy the house through the company, even if they're paying a proper market rent. So it's 15. It was 15%, and that's going up another 2% as well to 17%. They just want to discourage you from doing it, don't they?
So the government, I mean, they over many years, over 6 or 7 years, go back to George Osborne, may even be 10 years. They do seem to be trying to hit the landlord heavily. I mean, there's been a wave of changes. Firstly, the changes from George Osborne on the deductibility of loan interest.
Yeah.
And then there's been the stamp duty changes. There's also all the new regulations around tenant rights, etc. So it does seem to be becoming a more and more difficult market to be in, the landlord's market.
And double cab pickups. So we may recall that the previous government attempted to make some changes to double cab pickups. Those lasted about 48 hours before they changed the rules back again. So it was in July of this year that they attempted to change the rules to suggest that double cab pickups will no longer benefit from the allowances it achieves by classing it as a van. It will be classed as a car instead. There was uproar, and within 48 hours they reverted back to the previous rules and left it as it was. Well, we're back here again, and the new government have decided that they want to treat double cab pickups as cars with effect from 1st of April 2025.
So again, this is quite a big change, isn't it? Because historically, double cab pickups have been taxed like their vans. So that means they get beneficial tax treatment for both the corporation tax system, but also, more importantly, the benefit in kind system. So a business owner might have a double cab pickup, so a Ford Ranger or a Mitsubishi Animal or a Land Rover Defender, something like that, and they'd be treated like they're a commercial vehicle, which would mean there'd be a much lower tax bill.
Yeah.
So
plus potentially 100% tax relief in the company.
Yeah, absolutely. So 100% capital allowances relief in the company. So the previous government did try and change this, but there was such an uproar from the car companies that they changed their mind very quickly. But it looks like Labour have gone back in for it. So this is going to mean, so if you've got a large double cab pickup vehicle, it would have been a very relatively small benefit in kind, £3,000 annual benefit in kind. Well, if that's if that's got high CO2 emissions, which a lot of them will have, because they're big cars, the benefit in kind under the car system will be a lot higher.
Yeah, it will be based on the value of the vehicle itself. Yeah,
value of the vehicle multiplied by 37%.
Yeah,
So
a huge increase.
A huge increase.
It's a tricky one, really, isn't it? Because you can see, with farmers, clearly, they are really using them as commercial vehicles. And similarly, we've got quite a few construction clients, and they will typically have this because,
will.
yes, they're into the office, but they're also going out on site. And it makes sense to have a rugged vehicle. But then, of course, there's the brigade that spots a tax loophole and drives as many double tax cab pickups through it as they can.
Yeah.
So it's a difficult one, isn't it?
It is. So yeah, I think this will be consequential for quite a few clients. So I think possibly what a lot of them are going to have to do is they're going to have to just use those cars purely for business. So treat them as a pool car, as a pool van, and maybe have a separate car for their private travel, because otherwise the tax implications could be massive.
Yeah, absolutely.
So I think obviously quite a lot to talk about in the budget. For me, the national insurance changes are the big thing, alongside the inheritance tax changes.
Yeah.
Capital gains tax changes maybe not quite as big and serious as we'd feared. What are your thoughts, guys?
For me, because I deal with private client, I'm going to be extremely busy.
Yeah.
Inheritance tax is completely a massive change, and that's going to affect pretty much majority of our client base. So planning for clients is going to be essential now going forward, especially when we're looking at succession planning, passing assets down to the other generation rather than retaining them till death. It just makes no sense now.
But we've got a window now, haven't we, until the 5th of April 2026, and we haven't seen all the actual law itself yet. We're just going on what we've been told in the guidance, but there is a window of opportunity now to maybe do some transactions and try and get things passing down the generations. Because once we get to 2026, I think it's going to be more difficult.
Yeah, absolutely.
And things like trusts, which have been a tool that we've used for decades in tax planning, they're going to be less useful going forward, because they're only going to have they're going to have the same allowance as an individual, so a £1 million APR BPR allowance. So so we're going to need to be really careful when using those as well. So I think we are going to be very busy between now and April 26. And Julia, who does corporate mainly.
Well, this is it. I mean, very much got a watching brief.
Yeah.
Most of the rates and allowances just staying exactly the same for now. But it's a bit of a watch this space, isn't it?
It is, and I just I saw a bit of interesting reaction in the marketplace about how different people were reacting to the changes. So Jeremy Clarkson, who, as you probably know, he's a recent landowner. He's now a big farmer. He's got a farm shop. He's got a pub. So I think someone like that will be massively affected by the changes. And his viewpoint is, well, just keep yourself well for 5 years and then vote them out, because I don't think he's terribly happy. I think it's fair to say with the changes. But then the Guardian, obviously looking from a different viewpoint. I'm fairly staggered by this comment myself.
Massive understatement, isn't it?
Yeah. So they've said, well, largely just closed loopholes connected to farms, none of which is likely to be hugely contentious.
That's crazy.
So I mean, I beg to differ with that. I think that
Absolutely.
some of the changes are huge, and it is really going to impact on the ability of farmers and business owners to pass the businesses and farms down to the next generation. It's going to be really problematic. So, I don't know what effect that's going to have on the price of farmland. I don't know what effect that's going to have on a lot of things. I think we'll have to wait and see. But I think it is let's say that the Conservatives do get back in 5 years. You do wonder whether this is a short-lived change, but we'll have to wait and see.
Yeah.
We'll have to wait and see. So if anyone's got any questions, then please do contact any one of us or your normal Right by God contact. We'd be happy to speak to any of you about the changes and how they'll affect you. So it's goodbye from me.
And me.
And me.